Welcome back for the second video of this supply and demand course. In this video, we will be focusing on demand zones. To start, let's talk about what constitutes a demand zone. As we mentioned in the previous video, a demand zone is where an institution puts in a leveraged buy order where they are setting multiple limit orders to purchase an asset at a specific price. Now, how we can identify a demand zone on a chart is by looking for a small green reversal candle that is followed by a strong bodied green candlestick. The reversal candle can be either red or green, but demand zones are generally stronger when there is a green reversal candle. So for much of this course, you'll see examples where the basic reversal candle is green, but in your trading, the candle may be red and would still constitute as a valid demand zone. As we can see with these two candlesticks here, the smaller green one on the left can be used to identify the demand zone. To chart the demand zone, what you want to do is to use a rectangle that extends from the top of the green candlestick body to the bottom wick. Of course, if the reversal candle is red instead of green, we would still use the top of the red candlestick's body to mark the high of the zone. Notice in this diagram here, the top of the candlestick body marks the top of the range of the demand zone, and the bottom of the candlestick wick marks the bottom of that demand zone's range. Sometimes, the two candlesticks will set up something like this, where the second candle sees a lower low than the green reversal candle. When this happens, mark the bottom of the range using the low of the two candlesticks. So in general, the range of the demand zone goes from the top of the green reversal candle's body to the low of the two candlesticks. Let's take a look at some examples of this. I can apply this method to this chart here by first looking for a small green reversal candle and a strong bodied green candlestick. Once this is identified, I can then mark a rectangle from the top of the body of the reversal candle to the two candle low. By doing this, we have just identified a demand zone on the 1 hour time frame. You'll notice that when price re-enters this zone on the same 1 hour time frame, there is a quick spike down and up that is represented by these candlestick wicks, where unfilled limit orders are now filling. Basically, what is happening here is retail traders selling a position which creates liquidity for the institutional orders to fill. So what can be done by us is waiting for price to retest this level where we can set a buy order and ride up the bounce back to the upside. Here is another example of a demand zone that is established through these two green candlesticks here on the 30-minute time interval. As we can see, we have a small-bodied green reversal candle followed by a strong-bodied green candlestick. We can mark the demand zone like so, marking the rectangle from the top of the small green candlestick's body to the bottom of the green candlestick wick. Doing this just allowed us to identify a 30-minute demand zone. After watching how this move developed, once again, we can see that when price re-enters this area, it quickly bounces back upward as institutional orders are filling and a nice move to the upside is seen. For us to trade like institutions, we would set limit orders to also fill in this area or wait for a retest with confirmations, which we will go over how to do in future videos in the series where we can identify an entry there. On this chart here, we are looking at a demand zone being formed on the daily time interval. Notice on these two candlesticks here, we have the exact same setup that we're looking for to identify a demand zone. Here we can see a small-bodied green reversal candle accompanied by a strong green candlestick that comes just after. Using the same method as we have used in the previous examples, we can mark the rectangle from the top of the small green candlestick's body to the bottom of the green candlestick wick. Now we have identified a daily demand zone. As I run what happens next as this move develops, we can clearly see that when price re-entered this demand zone, a strong move to the upside occurred after the wick of the candle touched along the inside of the demand zone. This is another example of a demand zone at work and how price tends to react at these levels when identified correctly. But anyway, here's an example of a 2-minute chart where the second green candle makes a lower low than the green reversal candle. In this case, we would just use the low of the second candle to identify the demand zone. Now let's watch this move develop and again take note of what is occurring when price re-enters the zone that we just have identified. As we can see, when price re-enters this zone, price quickly bounces back upward as those limit orders are now filling. Nonetheless, the demand zone works the same as the others from the examples we have seen. The only difference is that we use the low of the second candle instead of the first. So in general, as we have mentioned, it is best to use the low of the two candlesticks to identify the demand zone. However, it is imperative to understand that not all demand zones are equally as strong. When looking at a set of candles that establish a demand zone, a good rule of thumb is to use the length of the second green candlestick in the two candlestick formation to identify how strong the demand zone is. If the second green candle is very strong, where it has a large body, it is likely to be a stronger demand zone. And similarly, if the candle's body is smaller, the weaker that zone is likely to be. Strength in this case can be a useful indicator of how hard of a bounce off this level we will see when price retests this zone. The stronger the zone, the stronger the bounce is likely to be. Here is a quick diagram depicting the strengths of zones depending on the size of the second green candle in the formation. As you can see, the larger the candlestick's body, the stronger that zone is likely to be in terms of a price bounce off of that level. Let's compare some demand zones based on their strengths. With this first demand zone here, we have a strong bodied green candlestick that follows the small bodied green reversal candle. And keep in mind, both of these examples will be on the daily chart. But anyway, this demand zone would be marked from the top of the small green candlestick's body to the low of the two candles like we are doing here. Now let's take a look at the second demand zone here. We have a medium strong bodied candlestick that follows the small bodied green reversal candle. I say medium strong for two reasons. Namely, it has a longer top wick, which shows that buy volume was not fully controlling the move of this candle, and also the fact that the body of the candlestick is relatively smaller than the last example that we saw. So for the strength of a candle, you are looking at two things: the length of the top wick, as well as the length of the body of the candlestick. The smaller the top wick and the longer the body length is, the stronger that candle is, and vice versa. But anyway, let's mark this demand zone using the same method that we have been, and take a look at how price reacted when it re-entered the two different demand zones. To avoid confusion, we'll label the second demand zone as the weaker daily demand. First, on the stronger example here, watch how as price re-entered this zone, there was a sharp and strong bounce that occurred off of this level. Following the bounce, there was a very clean move to the upside as well. Now let's compare this to see how the weaker demand zone held up when price re-entered this region. As we watch this play out, we can see that the move that occurred after the retest of this zone was much weaker than the first example, and this zone even ended up breaking down shortly after bouncing off of this level. Both zones were demand zones nonetheless. However, the demand zone that was established with a stronger second green candlestick in the formation corresponded to a stronger move off of the level. There is another factor that corresponds to the strength of a zone, and that would be identified by the time frame that you are using to chart the zone. This has to do more with the fractal nature of the market, where larger moves consist of multiple smaller moves that all follow the same general shape. The smaller move, of course, would be happening within the larger moves and on a much smaller scale than the larger moves. So with this being said, the longer time intervals that are used generally correspond with larger moves. We can use this concept to understand strengths of demand zones, as longer time frames will create much stronger demand zones than shorter time frames will. For instance, a demand zone on a daily interval will correspond to a larger move that follows a bounce off of a level, as opposed to a demand zone on a 15-minute interval, which will have a bounce that is much smaller than the bounce that occurred on the daily demand zone. So a larger price target can be used for entries on the longer time frame demand zones. The bounces that occur off of a demand zone are all going to be proportional to the time frame that was used. If a daily demand zone is used to identify an entry, you would have a much higher price target than, say, if you use a 5-minute demand zone to identify the entry. Likewise, if you identify a demand zone on the 5-minute interval, you wouldn't be using the daily chart to identify a price target, as the move that follows the bounce off the 5-minute interval will be proportional to the 5-minute charts rather than the daily chart. We will be talking about where to take profit with this strategy in future videos, but for now, it is just important to understand how large a move will occur is proportional to the time frame that you are using. Sometimes, you will notice that demand zones on different time frames are overlapping with one another. This would be referred to as an overlapping zone, and overlapping zones create for a large imbalance between supply and demand, where there is a lot more demand than supply, thus tending to push the asset upward in a much stronger manner. So overlapping zones are considered to be very strong zones. Showing this directly on the chart might make it a bit easier to understand this concept. Here we are on TradingView looking at an ES price chart. Take a look at this example of a demand zone here, where there is a small green reversal candle and a strong body green candle that follows it. Notice, if I go ahead and mark the demand zone here, we have just identified a daily demand zone. Now, if I go ahead and move down to the 4-hour time interval, and I look back into this zone, you'll notice that, once again, we have identified another demand zone within the demand zone of the daily chart. So we have a 4-hour demand zone within the daily demand zone. And if we go ahead and play this out, let's see what happens with price as it re-enters this zone. As we can see, when price re-entered both of the two zones, it bounced up quite strongly. And if we go ahead and play this out even further, we'll see that price moved very sharply and nicely off of this level. All right, well, a question you may be wondering is if demand zones are consistently the same strength as price re-enters the same zone time and time again. The short answer to this is no, and let me show you why. Thinking back to the basics of demand zones, they are created when institutions are setting multiple limit orders at that level. Well, every time price re-enters this level, some of those limit orders are being filled. And each time some of those limit orders are filled, there are going to be less that are left to fill the next time price re-enters this area. So each time price re-enters the level, there is less of an imbalance between supply and demand, so price will not see as strong of a bounce from the leftover limit orders alone. When a zone is retested 3 or 4 times, it causes for the zone to be used up, where not many limit orders are sitting there left to be filled. So when price re-enters that used up zone, it is a lot easier for price to continue downward since there is less of an imbalance between supply and demand. Thus, you generally wouldn't want to be entering in a used up zone as there aren't as many limit orders left for you to ride the wave back up with. Taking a look at this example here, we'll see that price re-entered this demand zone 3 different times. When price re-entered the zone following this, it found it much easier to break through the zone and move downward. Also, it is clear that each of those bounces were a bit weaker each consecutive time that it approached the zone. When the balance between supply and demand became evened out, price made a clean move through this level and to the downside. Anyway, in future videos, we will cover more about these zones in terms of how to precisely make a play using them. But this video focused more on identifying the zones and understanding what was happening when price came back down to the zone. In the next video, we will focus our attention on the counterpart to demand zones, which we have identified to be supply zones. Stick around and continue progressing through these videos to learn more about supply and demand trading strategies.